In this video, we're going to cover 4 of the biggest mistakes that can derail a retirement and how to make sure that you're not doing them, coming up on the Fed Corner. The first big mistake is not planning for long enough. Whether you plan to retire fully or just reduce your time working, how can you make sure that the years ahead of you are just as rich and meaningful as you envision them? Your retirement could last as much as a third of your whole life, so how do you make sure that your money lasts that long? Too many retirees make the mistake of underestimating how many years they're going to need to fund in retirement. Take a look at this chart. These are life expectancy probabilities, meaning that if you're in good health, which is represented by these brighter colors here at the top, there's a high probability of your living to age 85 or even 90, particularly if you are a couple. It's not until we get to age 95 that we truly start to see probabilities start to reduce heavily. And this can hurt you in quite a few ways. The first is obviously that you just didn't plan for living as long as you actually did. But what if you did factor living into your 90s in your plan, but there were some badly timed bear markets along the way? Or what if you didn't realize that you were overspending in the earlier years of your retirement? Longevity is a big risk to a federal retiree. And one way that you can help protect yourself against this is by having a bucketed approach to your investing. This allows you to have specific parts of your portfolio that are designed to deal with the different stages of your life. I won't go into the details of the bucket investment strategy in this video because we've done other videos on it. So we'll try to put a link in the description for you. Mistake number 2 is assuming that high-performing investments will allow you to be successful. Folks, this is a big one. Just because the S&P 500 has done really well over the last X years doesn't mean that it's going to continue to do well as you approach retirement and live through those retirement phases. And here's why. I know this chart looks a little confusing, but let's talk it through. First, let's just draw a line straight down the center, and for the first part of this, focus only on this left side. Here we have the performance quartiles of US large blend funds from Morningstar. And this graphic takes the best performing funds that are in the top quartile, meaning 75% of the other funds performed worse than these top quartile, and then shows us which quartile they were actually in the following 5 years after having been in the top. So the top quartile in 2013 by 2014 was actually in the bottom quartile, only the bottom 15%. The second to bottom in the following year at 31%. And then again back down to the bottom quartile for the next 2 years, ending the 5th year as well in the lowest quartile. Over on the right side, it's a similar concept only in reverse. These were the 5 years just prior to the year that these funds were in the top quartile. Before it was the following 5 years, and this is the previous 5 years. You'll notice that all of the years, except for the year just prior of it being in the top, they were all in the lowest quartile of performance. And even the year prior, it was still the second to the bottom quartile. Now, what does all of this actually mean? How many times have you picked an investment fund, whether it be the TSP CS&I funds, or anything outside of the TSP, simply because they were doing well and you wanted to participate in that growth? I don't even need to ask this because I know the answer. An overwhelming majority of TSP participants do this every time that the market is volatile. The TSP publishes investment flows into each of their funds, and we always see TSP participants flood the CS&I funds after they've shown to have good performance for a period of time. Now, if you're still working and will be for years, you've got plenty of time if you're wrong or if you missed the boat. But in retirement, time isn't on your side anymore, and so you can't be haphazard with your investment choices. Now, this segues nicely with the next mistake, which is trying to time the markets. Now, before you skip ahead and tell yourself that you're not a market timer, ask yourself the following. Have you ever made a decision in your portfolio based off of whether the markets were going up or down? If you said yes, then that is a form of market timing. If you said no, then you should stop lying to yourself, because everyone has some form of emotional connection to their money and to their portfolio. Our wealth represents something to us, whether it's safety or longevity. It could be comfort, or it could even be a sense of pride. Whatever it is, we can't ignore the fact that we feel something when we think about our wealth. Check this out. This chart represents S&P growth as an example. And from 2003 to 2022, it averaged about 9, almost 10% on an annual basis. But what's interesting is that if an investor missed only 10 of the best days during these 20 years, they would have missed out on 43% of that capital growth. And what if they missed the best 20 days instead? as much as 70% of this growth would have been lost. Now think about how volatile the markets were during those 20 years. Think about how much happened that made you think about whether or not you still wanted to be invested in the markets. There were probably some times that made you want to jump out of the markets. Now, maybe you didn't because you were younger and you were still working, so you knew that you had time to recover. But if the repeat happened and you were about to retire, would you have felt differently? Could you have stayed invested throughout all of those market crashes during the whole time? And what about the fact that now as a retiree, you're probably using your portfolio to support your lifestyle and other choices in retirement? Would you be forced to be selling at a loss? And folks, if you think you would not fall for this, think again. There's a lot of research that shows how individual investors often underperform the very index funds that they are using as their investment vehicle. This chart shows us that the average equity investor over 10 years performed over 3% worse every year than the actual S&P 500. And this difference is called the behavioral gap. Carl Richards, a New York Times author, has done a lot of work in this area, and he talks a lot about how investors can often be their own worst enemies. Think about what this 3-ish% annually compounds over time. This could potentially equate to hundreds of thousands of dollars in less returns that you experienced simply because you allowed your emotions to help you make your investment decisions. Human nature is a failed investor, especially when it comes to preserving our wealth and the hard work that we've built for our family. When the economy is on the brink of a recession or the markets become volatile, our instinct is to protect what we have. And one of the best things that you can do for your investment portfolio is to completely remove the emotion from your decisions. But that's really hard to do when you're trying to think about what the best strategy is for your family. All right, before we jump to the next mistake, I've noticed that almost 80% of you are not subscribed to our channel yet. If you're enjoying this video and you like this kind of content, then make sure you hit the subscribe button so that you can keep up with our new videos. The next massive mistake we see federal employees make in retirement is ignoring the power of diversification. Everyone is very focused on how the S&P 500 is doing these days, which the TSP equivalent is the C fund. And that's not surprising. The S&P has done a lot recently, but soon-to-be retirees need to remember that a lot of the growth in the S&P has been concentrated to about 7 stocks. Now, don't get me wrong. I firmly believe that the S&P 500 belongs in almost everyone's portfolio to some degree, but it's not the portfolio strategy. We cannot fall for the recency bias of how well the S&P has performed lately and think that that is the only kind of stocks that we really need in our portfolio. This becomes even greater of a factor once you're retired. How many times have you seen the line, "Past performance is not a guarantee of future results"? That's because while there are trends, you can't know what is looming around the corner. And if all of your stocks are comprised of S&P 500, then you could see a whole lot more volatility and create greater risk to your financial independence. Here's another chart for you. This one is showing the major asset classes and their performance from 2012 all the way through 2022. Now let's take large cap growth as an example, which is what led the bulk of the growth last year and much of the growth still this year. How did it do in 2022? Well, they were one of the worst performing asset classes in 2022. But the 2 years prior to that, they were in the top 3 best performing asset classes. And really, they've been all over the place over the last decade. And if you were to connect a line through all of these, you can really see how volatile this kind of portfolio would have been. The same is true with small cap, which is another asset class that is very popular with folks. Very volatile as it goes through its own sequence. But if we look at a simple 60-40 portfolio that is well diversified, in this example, can you see how much less volatile this portfolio would have been? Now, I am not saying that a 60 portfolio is the portfolio for you. Frankly, it varies for everyone. But the point here is that when you are retired, you no longer have the time nor tolerance to be able to sustain this crazy amount of volatility. What you need in your portfolio is sustainment and efficiency. By having a proper and well-diversified portfolio, you can reduce that amount of volatility, reduce your sequence of returns risk, and provide stable income for the time of your life that you need it most. This is how you can give yourself the best chance of achieving your goals in retirement. Now, how to diversify a portfolio correctly is a topic for another video, so click the like button on this video if you'd like us to create a video on that. And again, make sure to subscribe if you haven't already. And until next time, stay wise and stay wealthy.